Somebody claims Social Security at 63. A few months later, they take a part-time job, and then 1 month the payment simply does not arrive. Not smaller. Nothing. Then the next month, nothing again. No letter arrives explaining it. That is not an error, and it is not a punishment. It is a rule called the earnings test, and it works in a way that surprises almost everybody it happens to. I'm going to answer 4 questions in this video. Why the payment stopped completely instead of just going down. Whether that money is gone. Which kinds of income actually count, because most people get this badly wrong. And what happens the month you reach full retirement age. Stay with me to the end, because the answer to the second question is the opposite of what most people assume. And there is one detail near the end that means some people earning a great deal of money see nothing withheld at all. So, the rule itself. If you are receiving Social Security and you have not yet reached your full retirement age, there's a limit on how much you can earn from work before Social Security starts holding money back. For 2026, that limit is $24,480. Earn above it, and they withhold $1 for every $2 you are over. Now, that sounds like a gentle reduction, and here's where the first surprise comes in. Social Security does not shave a little off each monthly payment. They withhold whole months. So rather than a slightly smaller check 12 times, you get nothing at all for several months, and then normal payments resume once the total has been covered. That is why people describe it as their payment stopping and why it feels like something has gone wrong. Now, the second question, and this is the one I most want you to hear because a great many people believe the wrong answer and make decisions based on it. When Social Security withholds those payments, that money is not lost. It is not a penalty, and it is not forfeited. Social Security keeps count of how many months of benefit were withheld. Then, when you reach your full retirement age, they recalculate your benefit as though you had claimed later than you actually did. Your monthly payment goes up permanently for the rest of your life. So the correct way to think about the earnings test is not as a fine. It is closer to a deferral. The money moves from now into later, and it comes back as a bigger monthly amount rather than a lump sum. Right? Third question. And this is the one that changes people's plans because most people assume the earnings test looks at all their income. It does not. It looks only at earned income. That means wages from a job and net earnings from self-employment. That is the whole list. Everything else is invisible to this rule. Your pension does not count. Money you withdraw from a 401k or an IRA does not count. Interest does not count. Dividends do not count. Capital gains do not count. Rental income does not count. Annuity payments do not count. So somebody living on substantial investment income and a pension, who takes a small part-time job, is measured only on that part-time job. I have seen people delay claiming for years because they believe their investment income would wipe out their benefit. It would not have. It is not counted at all. Let me pause here because we are about halfway, and I know not everybody stays to the end. If you take one thing from this video, take this. Before you assume the earnings test affects you, work out how much of your income is actually wages or self-employment. Just that. Not your total income. Not your household income. Not what your tax return says at the bottom. Only what you earn from working. For a lot of retirees, that figure is far smaller than they think. And for some it is nothing at all, which means the earnings test does not touch them. Write that number down. If it is under the limit, you can stop worrying about this entirely. And if this is useful, subscribing is how the next one reaches you. Now the fourth question. What happens when you reach full retirement age? And the answer is refreshingly simple. It stops. Completely. Starting with the month you reach your full retirement age, there is no earnings limit at all. You can earn any amount, and your Social Security is untouched. For anybody born in 1960 or later, that age is 67. But there is a middle step in the year you actually reach it. And this is the detail I promised you at the start because it catches people out in both directions. In the year you reach full retirement age, the limit is much higher. $65,160. And the withholding is gentler, $1 for every 3 above it rather than 1 and 2. But here is the part almost nobody knows. In that year, only the money you earn in the months before you reach full retirement age is counted at all. Let me say that again because it matters. In the year you reach full retirement age, earnings in the months from your birthday month onward are not counted. So somebody who reaches full retirement age in March and earns a great deal across the year is only measured on January and February. Everything from March onward is invisible. That is why some people earning far more than the limit see nothing withheld at all, and why the same salary can produce a completely different result depending on which month your birthday falls in. If you're approaching that year, this is worth understanding before you decide when to take on extra work. Now I want to give you something specific because this next one is worth real money and almost nobody knows it exists. Say you retired in the middle of the year, and afterwards your employer paid you out for accumulated vacation, or unused sick pay, or a severance, or a bonus you had already earned, or deferred compensation. That money arrives after you retired, but you earn it before. And here's the rule. Wages earned in a year before they are paid generally do not count against the earnings test. They should be excluded, but Social Security will not know that automatically. Somebody has to tell them, and the way they are told is a form called SSA-131, the Employer Report of Special Wage Payments. Your employer completes it and sends it to Social Security. And here's the part that matters. Until that form is submitted, Social Security cannot exclude those payments. They will count them, and they will withhold benefits accordingly. So if you retired this year and received a payout of anything you had already earned, ask your employer whether they have filed Form SSA-131. That single question can be worth several months of benefit. There is one more provision, and it applies in the first year you claim. It is called the Special Monthly Rule, and it exists because the annual test would otherwise be unfair to somebody who retires mid-year. Normally, the earnings test looks at your whole year. But in that first year, Social Security can look month by month instead. If your earnings in a given month are below the monthly figure, you receive that month's benefit, no matter what your annual total looks like. For 2026, that monthly figure is $2,040, which is simply the annual limit divided by 12. So somebody who earned $80,000 in the first half of the year and then retired in July can still receive benefits for July onward, because those months are below the monthly line. Two things to know. It is available for 1 calendar year only, and after that the standard annual test applies. And you have to tell Social Security you are using it. It is not applied automatically. Now, there are 4 questions people always ask about this, and I would rather answer them here than have you go looking. First, does it apply to spousal benefits? Yes. If you're claiming a spousal benefit before your own full retirement age and you are working, the same test applies. Second, what if I go just $1 over the limit? Then a very small amount is withheld. The reduction is proportional, so a small overage produces a small withholding. It is not a cliff. Third, does my spouse's income count against my benefit? No. The test looks at your own earnings, not your household's. And fourth, the one people ask most often, if I regret claiming early, can I undo it? There is a narrow provision for withdrawing an application within 12 months of claiming. The form is SSA-521, the request for withdrawal of application. It requires repaying every dollar you and your family have received, and you may only ever do it once. It exists, but it is genuinely narrow, and it is a conversation to have with Social Security directly rather than a decision to make from video. So let me pull the 4 answers together. 1. Your payment stopped completely rather than shrinking because Social Security withholds whole months rather than trimming each check. 2. That money is not lost. It is credited back at full retirement age as a permanently higher monthly payment, though how much you recover depends on how long you live. 3. Only earned income counts. Wages and self-employment. Your pension, your investments, and your retirement account withdrawals are invisible to this rule. And 4. The whole thing ends the month you reach full retirement age. And in the year you get there, only the months before your birthday month are counted at all. So here's exactly what to say when you telephone them. The number is 1-800-772-1213. Have your Social Security number in front of you. Then say this: I am receiving retirement benefits, and I am working. I would like to confirm 3 things. First, what earnings figure do you currently have on record for me this year? Second, have any benefits been withheld under the earnings test, and if so, how many months? And third, if I received a special wage payment after retiring, has Form SSA-131 been received from my employer? Write down the answers, and write down the name of the person you spoke to and the date. That last part matters more than people expect, because if there's a dispute later, a note saying who told you what is the difference between an argument and a correction. One last thought. The earnings test frightens people out of working, and I think that is the real cost of how badly it is explained. Somebody turns down a job they would have enjoyed because they believe they will lose the money permanently. They will not. It is deferred, not destroyed. And a great many of them would not have crossed the limit anyway, because the income they were worried about was never counted in the first place. Everything in this video is general education, not financial advice, and these figures are for 2026 and change every year. Social Security published a short leaflet on all of this, publication 05-10069, called How Work Affects Your Benefits. It is free and it takes about 10 minutes to read. Please confirm your own position with them directly. If this was useful, subscribing is how the next one finds you. And if your payment ever stopped without warning, tell me in the comments what happened, because it is the most common story I get and I read every one. Next time, I am covering how Social Security benefits get taxed, which trips up almost everybody who goes back to work. Thank you for watching.